Here's the thing. Most investors panic when the market drops. Some literally sell their entire portfolio at the worst possible moment. Why? Because volatility triggers fear, and fear makes us do stupid things with money. If you invested $10,000 and the market dropped 20%, you'd see your account shrink to $8,000. If you panic sold, you lock in that $2,000 loss. Surviving this isn't about just waiting it out. It's about building a portfolio designed to withstand those shocks without giving you sleepless nights. Let's start with our own brains. We are wired to react to losses far more than to gains. Behavioral economists call it loss aversion. Losing $1,000 feels about twice as painful as the joy of gaining $1,000. So when the market drops, we don't just see numbers go down, we feel a visceral threat. Panic is instant, and that's when the bad decisions happen. But here's what most people get wrong. Volatility isn't the real enemy. Risk is. Volatility is just the short-term price swings. It's noise. Uncomfortable, yes, but not necessarily dangerous. Risk is the chance of a permanent loss of your money. That's what actually matters. An investment can jump up and down wildly, but still make you rich in 10 years. Another can move smoothly, but carry a small, hidden chance of failing completely. The first one is volatile. The second one is risky. Once you build your portfolio with real risk in mind, volatility stops being so scary. It just becomes background noise. So how do you build this resilient portfolio? It comes down to 3 principles. First, diversification, but not just across different stocks. You need to spread your money across different kinds of assets: stocks, bonds, real assets like gold, and even cash. This cushions the blow when one area gets hit hard. Second, liquidity. This is your financial seatbelt. You need some assets you can get to easily without being forced to sell your long-term investments at a loss. Third, risk-adjusted allocations. Don't just chase the highest returns, balance them with the potential pain of a loss. Instead of putting all your money in a high-growth fund that could drop 40%, you allocate less there and more to something stable, like bonds. The total loss becomes smaller and, more importantly, psychologically manageable. Let's make this concrete. Imagine you have $100,000. A resilient portfolio might put $50,000 in stocks, $30,000 in bonds, $10,000 in gold, and $10,000 in cash. Now, let's run a stress test. The market drops 20%. Your $50,000 in stocks is now worth $40,000. But maybe bonds only drop 5%, and gold actually rises 5%. Your total portfolio is now worth about $89,000. That's an 11% drop, not a 20% one. The loss is cushioned, giving your brain a fighting chance to stay rational. Asset allocation isn't about avoiding volatility. It's about surviving it without losing your mind. Here's a final mental trick to carry with you. Treat your portfolio like a shock absorber, not a sprint car. Its job is to survive the bumps, not win every short-term race. A portfolio averaging 7% a year will nearly quadruple your money in 20 years, even with a big drop along the way, as long as you don't panic. A resilient portfolio isn't about avoiding the drops, it's about surviving them calmly with a plan. You're building it for your mind, not just for your returns, because the market doesn't care about your emotions, but your future depends entirely on them.